All right, hopefully we've got everybody settled in. So we'll officially get underway and thank everybody for joining us this evening or this morning, as the case may be, for our discussion of counterproductive sustainable investing. I know we've got people on the call from the Asia Pacific region, the United States and Canada. So again, wherever you are, thanks very much for joining us. Today, we're going to explore research from two professors that challenges a popular approach to one aspect of ESG investing, and that's namely excluding brown or high-polluting companies from a portfolio. And as the title of their paper suggests, the results of those efforts often are counterproductive and perhaps counterintuitive. So in a moment, I'll introduce each of our experts. I'll ask them to walk through the results at a high level, and then we'll open the floor to questions. I want to make our 1 hour together as interactive as possible. I've got a bunch of questions queued up for our guests, and I'm happy to get the conversation started. At the same time, I welcome and encourage your input. So if you have a question or a comment, just click on that little Q&A icon on the bottom, and we'll get to as many of your questions as we can. Before we dive into our topic today, just want to make a few announcements. First, I'm Bob Schmidt, Executive Director of the Brandeis Center at UC San Diego's Rady School of Management. I'll be moderating our session today. The Brandeis Center regularly hosts online webinars such as this, and each time I have a number of people to thank here at the Rady School for their work in making these events possible. I want to start with Assistant Dean Wendy Hunter Barker, my colleague Priscilla Morales Salazar, and the IT team at Rady, especially Elise Grail. Thank you also to Keshav Sharma, our Brandeis Center research intern, for all your work in promoting today's event, as well as the marketing team at Rady. And speaking of promotion, thank you to all my friends at Brandeis Investment Partners, especially in San Diego and Singapore, and Bridgehouse Asset Managers in Canada for your work in promoting this event. Also, of course, I have to thank Charles and Renee Brandeis. Really, it's their generosity and vision that makes the Brandeis Center, our research, and these types of events possible. So just a heads up, we are recording today's event. We'll share the recording with each person who registered, and we'll try to get it out to you next week, or more likely the following week. And last point, we're going to discuss investment approaches today. We might even talk about some specific securities, but we are not making any investment recommendations. Before you invest in anything or divest of anything, we encourage you first to talk with colleagues, fellow board members, perhaps a consultant or a financial advisor. All right, I think we've set the table sufficiently, so let's introduce our guests. They are winners in the Brandeis Center's $25,000 Call for Papers contest. First, Dr. Kelly Shue. She's a professor of finance at the Yale School of Management, and she describes her research interests as the intersection of behavioral economics and empirical corporate finance. She's an associate editor at the Journal of Finance and Journal of Financial Economics. She's earned 3 degrees, all at Harvard: a bachelor's in applied mathematics, a master's degree in economics, and her PhD in economics. Her work has been featured on CNN, NPR, and in the Wall Street Journal, among other media outlets. So Kelly, thanks very much for being here. Also, we've got Dr. Sam Hartzmark. He is professor of finance and Hillenbrand Family Faculty Fellow at the Carroll School of Management at Boston College. Previously, he was an associate professor of finance at the Booth School at, of course, the University of Chicago. He earned his BA in mathematics at Emory University, an MBA from Booth, and his PhD at the University of Southern California. His work has been featured in Freakonomics, Bloomberg, and Forbes, among others. So again, thanks very much to Kelly and Sam for joining us today. I'll turn things over to Sam, and if you would, just walk us through the premise of your work, share the results, and we'll kind of get this conversation started.
Awesome. Let me share some slides. Are they showing up?
Yeah, looks great.
Excellent. Awesome. Well, thank you, Bob, for the great intro and the invite to talk tonight. So this paper that we're talking about is joint with Kelly. And, we're all here talking about ESG investing. Sorry if I can get slides to advance, because, of course, ESG investing has just exploded in popularity. And while there are a myriad of different ways this has been implemented, there are some clear dominant ways that these types of strategies have in practice actually been going on in financial markets. So what is it that most people are trying to focus on? Well, most people tend to focus on the environment. Most people tend to focus on fighting global warming through decreasing greenhouse gas emissions. Clearly, many other important things that are out there that investors care about, but this is probably the one that has received the dominant amount of attention. What other things have been going on in terms of, say, goals? What are investors trying to do? Well, most investors say they are trying to transition to a green economy, which is very much a two-pronged goal. First off, you want to go and make firms more green. And second, you want to minimize economic disruptions from doing so. And then what is the strategy that people have been trying to implement? Well, most investors have basically been trying to buy the firms that they consider green and avoid buying the firms they consider brown. And everything I just said is kind of true at a very high level. There are, counterexamples to all of them, but our papers really kind of take this dominant strategy, focus, and goal and think about those things. So what are they trying to do? Well, the mechanism of these investors has to be through shifting firms' cost of capital. They're trying to direct capital towards green firms, lower their cost of capital, and away from brown firms and increase their cost of capital. So what we want to ask is what will happen if these investors succeed in changing the cost of capital of the firms that they are targeting? Will it actually achieve this green transition goal? And what we argue is this depends on what we're going to call the impact elasticity, basically how emissions intensity changes due to cost of capital shocks and how that varies based on brown and green firms. So before we get to any results, I think it might be useful to just kind of think about some intuitive examples of what these firms are. So what's a green firm? Well, a green firm is a firm like Travelers Insurance. S&P 500 firm emits 1 ton of greenhouse gases per million revenue. This is very, very green. And they've managed to roughly halve their emissions in the last few years. They say they'll be net zero in the near future. Now, what's a brown firm? Well, a brown firm is someone like Martin Marietta. They manufacture cement. They emit 1,000 times per $1 million of revenue. And they've also cut emissions by about 10%. And if you read their sustainability reports, they discuss getting more green, but it's modest. And they discuss how it's achieve any of those goals. So what would happen if everyone bought Travelers and avoided Martin Marietta? Well, when it comes to Travelers, the answer is not very much. It's an insurance firm. It's very, very green. If it went to zero, it would be the same as cutting Martin Marietta by 0.1%. And there's really no reason to think they could produce cement. They would do green R&D, anything like that. Now, Martin Marietta can get a lot more green or a lot more brown. You decrease its cost of capital. It can make those green investments they say are currently cost prohibitive. You shock it upwards, it's going to focus on its survival, need cash today, cut corners. It can get very brown very quickly. So what our paper shows is this intuition tends to hold kind of broadly in the data. Green firms have an impact elasticity of about 0. Brown firms have a big negative impact elasticity. So what this means is if sustainable investors actually succeed in changing the cost of capital of the firms they're trying to change, it will be counterproductive relative to the goal of a green transition because the green firms aren't becoming any more green, but the brown firms would be becoming more brown. Now, of course, there are other things investors might be trying to do. For example, trying to get brown firms to get more green. In theory, it makes a ton of sense. We're going to show you in practice, these incentives just aren't there. The last thing is investors could be trying to shrink brown firms and grow green firms to make up for that lost output. But we're going to show that, again, in practice, these strategies aren't being implemented in that way. Basically, investors are avoiding brown industries, for example, agriculture, holding things like insurance. You can't shrink agriculture and keep feeding people in a green transition goal without growing relatively green agriculture. So the main thing we're going to look at in this paper is kind of measures of shifts in emissions intensity, which is going to get us this measure of impact elasticity. We're going to start by looking just a broad class of cost of capital shocks, regardless of where they come from. The underlying assumption will be if green investors shifted cost of capital in the same way, firms would behave similarly. And then the last two results are going to be about, well, what if that result isn't there? So the paper has a lot of regressions like this, where the left-hand side is going to be the change in emissions intensity. Right-hand side is going to be for proxies of cost of capital. Here we just have firm performance. And so what is this showing you? Well, it's showing you that brown firms that did well recently emit less, and green firms that did well or poorly recently don't change at all what they were doing. And this is consistent with brown firms having a big negative impact elasticity, green firms basically being unresponsive. Now, the paper digs into this in a lot of detail. We look at longer term changes, we look at financial distress, we look at purely financial shock, and basically, no matter how we measure it, we find a very similar pattern in the data. So this suggests that there is this direct effect of shifting cost of capital, leading to a negative impact elasticity for brown firms. But of course, it could be that green investors are trying to reward brown firms who've gotten better. And theoretically, this could totally be the case, but the data seems to suggest otherwise. So what we've got here is how green funds are holding firms and how much they're overweighting or underweighting those firms based on emissions. And the first thing to note is green funds just don't hold things with high emissions, but do they reward firms that have improved? Well, if you look at firms that have just done better in terms of emissions intensity, the answer is no. But if you look at how firms have done in terms of percentage change in emissions intensity, the answer here is actually yes. Now, this might sound good, but the problem is this is actually the wrong metric, because Martin Marietta changing by 1% has 1,000 times the impact of travelers changing by 1%. This is the wrong unit to reward firms in, but it seems to be the one that's focused on, and it's commonly used in a lot of places in an industry. And the paper shows ESG ratings does that as well too. Finally, it actually, that 1% change for Martin Marietta, that's 1,000 times the change for the green funds. It turns out that's actually underweighted as well too. Almost all of the incentive in the wrong unit is focused on green firms getting better. Brown firms aren't even rewarded in that wrong metric. The last thing we look at is, are investors shrinking brown output and growing green input to make up for the lost output? And the key thing here is a lot of brown output is hard to substitute away from. Things like agriculture, building materials. So if you had a green transition goal, your goal would be to kind of grow relatively green agriculture, shrink relatively brown agriculture, so you could keep feeding people at a lower emissions intensity. Now, that's not what investors do. They just avoid agriculture. Agriculture's weight is about 80% too low compared to what they would just possibly been doing. It's avoided. And if you look in the data overall, that's just what the data is saying. High emissions industry are avoided. People are not growing the relatively green part of the sector. They're just avoiding it altogether. What are they kind of looking at instead? Well, they're the insurance firms, healthcare, financial services, firms that aren't going to replace brown agriculture, brown products, do green R&D, anything like that. So at a very high level, that's the paper. I think this is a great point to open it up for questions. Thank you again for having us, and very, very excited to talk more.
Sam, thank you. That's a great overview. And I've read your paper months ago, was scrambling to take some notes here. And if I heard you correctly, whether it's ESG funds or individual investors, they just tend to avoid the brown firms. And I think you said it might be better to look at some of these brown firms that are maybe less brown within an industry rather than just avoid them outright.
Yeah, so I think that's kind of what the evidence in our paper suggests is, if you want to say, and I think agriculture is a great example because it's one of the highest emitting industries, but it's clearly an important industry. We think feeding people is a laudable goal. And so if the goal is to say make agriculture greener, which should probably be the goal, well, the goal is not going to be to increase travelers' insurance to make up for the decreasing food production from the bad guys.
Right.
The goal is going to be encourage relatively green agriculture, maybe new technologies in agriculture, There are a number of ways it will be green, but if you're just looking at the distribution of firms overall, that green agricultural firm is going to be really brown compared to the whole distribution, because even if they're half the emissions output, they're not travelers, you know?
Right, right. And I'm just curious, there's a number of things that I want to get into, the data, the ratings agencies, how much they're helping or maybe contributing to the problem. The one thing I want to take a step back, you released this paper, I think in February of last year.
Sounds
So,
about right.
so just
Yeah.
curious, what has been the reaction? Maybe for Sam or for Kelly, what's been the reaction to this? And does it, I've got kind of a multi-part question here. Does it change if you're talking to asset owners like pension funds versus asset managers like mutual funds versus regulators or academics? And really, I'm trying to be a little dramatic here. I'm looking for the more polar responses to this. One group loves it and another group hates it, and or you.
Sure, I can take this one. Largely the response have been very positive from both asset owners and asset managers. Although we've been mainly talking about, even for asset owners, those that are kind of at the very top of so even though they're asset owners, really, I think they are still in some sense responsible to various other stakeholders. So the people we've talked to have been very sympathetic. One of the things I was actually quite glad to hear is, people say, I've been thinking this all along, that, we've been paying attention to the wrong set of firms that can't do much more good. And instead, if we punish a group of firms, and we push them toward bankruptcy, they might actually go out and pollute more. However, each manager that we've talked to have kind of talked about the constraints that they're working with, which is that they have a small vocal group of people really pressuring them to divest. And what they're facing is this kind of optimization problem in which ultimately they just kind of want happy clients, happy stakeholders. They're able to offer a pretty similar risk and return profile to their overall portfolio, even if they kick out a handful of brown firms where they underweight brown firms. So kind of their thinking is maybe we just do this. The other argument that we've been hearing, and I'm not sure there's much data to support it, is everything's now being argued through this risks channel, or materiality, which are buzzwords for this idea that we should underweight brown firms because they are more exposed to climate change risk or regulatory risk. Okay. That's possibly true. I'm not sure there's definite data to support that. But also that's a very different motive from wanting a green transition. If your only goal is risk minimization, then it's possible you divest away from certain riskier firms. And one of the ways in which firms are riskier is because they might be subject to high carbon taxation. I think that's a rational concern, but let's not pretend that exactly coincides with also motivating these firms to do better or helping the planet.
Yeah. Well, there's a number of threads that we could go down with what you shared there, but it's always interesting to me in terms of the risk. So is this an investment risk? Is this an environmental risk? Or as you alluded to earlier with a small vocal minority, is it more of a career risk? Is it a headline risk? Like, I don't want to own this stuff if it's going to get splashed in the press, and I'm there kind of holding these brown firms. So I don't know. I think having these types of nuanced conversations about the topic is helpful, but I don't know if it was in your paper or we had talked earlier about this, but people tend to like simple solutions to complex problems. Any thoughts
Yeah.
on that?
So I feel like we've got maybe a paragraph somewhere where we kind of discuss and this comes up when we get questions about what's kind of the optimal strategy our paper suggests. And our paper doesn't, like, it has certain things that we can suggest, but On some level, I feel like the punchline of our paper is this is a really difficult problem, and it's a nuanced problem, and it is not a simple one-size-fits-all type problem, and it's unlikely that you'll make meaningful progress if you pretend that it's a simple problem, which seems to, in practice, be what a lot of people would like to pretend. And I think, one of the ways you can see that is exactly what you just said, in terms of like, well, they say risk, but there's like 5 possible meanings. Each one would suggest a different strategy, and it's not clear which one they mean or how it relates to what they're doing. That should probably lead to skepticism about what's going on.
Yeah, great point. And got a couple of questions already in the Q&A, so thank you for those. Keep them coming. Are there any asset management firms who have taken note of your research?
Yes, so I think we've gotten some quite positive attention from asset management firms that have pursued a transition-oriented strategy. And I would say our research is broadly aligned with that. So there's a lot of variation within transition funds, but largely what they do is instead of divesting away from brown industries, they seek to actually invest in brown firms and provide motivation for them to change. So that could be either overweighting those that have meaningfully reduced their emissions, overweighting those that are relatively low emissions for their industry, or they could have a more targeted approach in which they try to own actually particularly high polluting companies, but try to engage with their board members or submit shareholder proposals. But this is a much more incentive-based approach targeted at the types of firms, and there's only a handful of them that actually matter for the environment.
Yeah, that's yet another interesting angle we could explore in terms of engagement / activist investing. Is that what you're proposing?
We don't necessarily, so there are limitations to engagement, I think practical limitations, although, I'm broadly supportive of efforts to practice engagement. But it doesn't have to go through active engagement. So for example, suppose portfolio weights were to respond and incentivize reductions in emissions in the right units instead of percentage reductions. That kind of change in ownership without necessarily interacting directly with the board and pestering them could, in theory, still be quite effective.
I think it's also noteworthy with the engagement that it's like a lot of the initial literature in academia was about like, well, if this works at all, we should be targeting brown firms in terms of, getting board seats and engaging with them and things like that. And then kind of most of the literature about investing hasn't been about targeting the firms that the initial engagement folks said, but not necessarily like, because that was wrong logically, just because industry evolved that way. And so, our paper is not really directly about engagement. It's a different mechanism, but the fundamental logic of improving brown firms being extremely important that kind of, I think, motivated engagement initially, I think the similar logic leads us to our results in our paper, even though our mechanism is slightly different.
Okay. And Kelly, you touched on something in terms of the percentage change in emissions versus absolute changes or absolute levels.
Mm-hmm.
So can you talk about that a little bit more, and then the data behind your research or what should investors be looking at?
Sure. So emissions is usually measured already relative to revenue. So it's basically how much you emit per unit of revenue. And firms like Martin Marietta are emitting somewhere like 1,000 tons per million of revenue, whereas a services firm such as Travelers starts at around 10 tons per million revenue. Okay. Or actually, was it 1 ton?
It was one for Travelers. They're very green. Yeah.
They're very green. 1 ton per million revenue.
Yeah. Average household in the US is about 40. So Travelers is doing great.
Yeah. So, I mean, this huge scale difference that they're starting at really matters, because imagine Travelers reduces its emissions by a mere 10%. So then it would be emitting, it would go down from 1,000 tons per million down to 900 tons per million. Okay, that is a huge reduction in emissions. Whereas if Martin Marietta reduced its emissions by 100%, it would go from 1 ton per million down to 0 tons per million. So 100% reduction sounds like a lot, but it started at basically up to a rounding error. It was started at 0 in the first place. So this is what we mean by it's really important to reward reductions in meaningful units, which is actually like the level reduction in emissions intensity going from 1,000 to 900 instead of going from 1 to 0.
Yeah.
It's been frustrating because there's actually a growth in demand for metrics for how green these funds actually are. But I'd say, like, I think in my opinion, I will probably be representing Sam as well. These metrics are actually even more problematic because there are these analyses of, are these funds actually green? And it will point to these funds having very high financed emissions. So that's basically, do you have high emissions per dollar of market cap that you own within your fund? Okay. And this is a very problematic measure because even if you own relatively green agriculture firms, you're going to end up with pretty high financed emissions compared to if you own a basket of, let's say, software growth firms, okay, that don't emit by the nature of their business. So there's ways to manipulate financed emissions, and they don't really represent kind of the actual environmental good that a fund might be doing.
And that's another great point. And did I hear you, Kelly, correctly, or Sam? It's easier for the green firms to show a larger percentage decrease in their emissions.
So, for example, Travelers recently roughly halved their emissions, and you can go and they're proud of it, and so they'll tell you exactly what they did. And so the list of things they did was basically they went to more efficient light bulbs and they improved the insulation in their buildings, and they switched to electric cars. And yeah, I mean, these were relatively straightforward things to do. I think it's also noteworthy, like Martin Marietta could do the exact same thing with the exact same environmental impact and would get no credit whatsoever because, it's rounding error in their data.
Right.
But yeah, I think it probably is relatively straightforward because so cement manufacturing is a very high emissions business just due to the chemical processes and the heat involved in cement. So you can make it more green, but it involves buying heavy equipment or more expensive inputs, and it kind of fundamentally alters the business in a way that putting in some building insulation and changing light bulbs is relatively cheap and straightforward.
Well, coming back to this notion of data, what is out there now, and what would you like to see more of? Like, what is it? The standard of what we talked about, tons per revenue? That's what most people are making their investment decisions based on. Or what else would you rather see?
So I would actually like to see an even greater focus on, let's say, emissions intensity. Right now, they are a key component of ESG ratings in general. But ESG ratings are themselves often kind of a big black box. And they depend heavily on whether firms make various promises that may not be credible. So did you make a promise to do something? Or are you choosing to disclose some information regardless of whether that information is credible or good or bad? While I think I actually support all of the various goals in or most of the various goals in the majority of ESG strategies, it does seem like we need to focus on one particular goal, which is the threat of global climate change poses potentially an existential risk to humans. So if we were to focus on that particular goal, that would say we have a bunch of emissions measures. The data could still be improved right now because it's easier to measure scope 1 and scope 2 emissions. So that's direct emissions, that would be scope 1. And then scope 2 is through the energy that I purchase mostly, right? Whereas scope 3 is all the other emissions through my supply chain and also what my customers do. Scope 3 clearly matters, but it's, you know, it's very difficult to measure. It also involves a lot of double counting because my scope 1 could be your scope 3. So I understand the problems with using scope 3. But right now, because scope 3 is not measured, we have something else going on in finance, which I think is probably counterproductive, which is we have a lot of assets changing hands in terms of ownership just to look good for ESG investors. So the idea is right now, let's suppose you're a large conglomerate company. Part of you is brown and part of you is green, okay? Then your overall firm emissions is still going to look pretty high, which gets you labeled as a brown firm and gets you on these divestment lists. So what's the smart thing for these firms to do? Well, they sell off their high polluting assets. And that way they are no longer labeled as a green firm. But when they sell off these high polluting assets, it's not as though the asset disappears and stops polluting. Instead, ownership just changes hands from public owners who probably care somewhat about the environment toward private owners who may actually care less about the environment or just have less expertise in terms of running the plant efficiently. So it's not obvious that emissions actually goes down. It's just public ownership of scope 1 and scope 2 emitting assets has gone down, and that's mostly through switching ownership.
Yeah, and if I'm a private equity firm, I've got less headline, less career risk because my disclosure requirements are far less onerous. So yeah, for the publicly traded firm, it's going to make them look good. The private equity firm may care less, but the net impact on the environment is the same. And maybe worse because the private equity firm potentially doesn't have the same pressure that a public firm is going to get, the same level of scrutiny among investors, let's say.
Yeah. And I've also seen a recent interesting study about an unintended consequence of what's happening with executive compensation. So there's been this pressure for ESG funds and green funds to engage with management compensation contracts and tie those to various emission or ESG targets, okay? So the manager goes through the same thought process, which is what is the easiest way for me to lower at least my scope 1 and scope 2 emissions? Well, I just push that further to outside of my supply chain, okay? Down to my supply chain. Therefore, I'm not producing in-house. I buy that from somebody else down my supply chain, and therefore I've lowered my emissions. And again, that's not obviously good for the environment at all.
Yeah. Yeah. All right. So there's a bit of a shell game, perhaps, with how you're calculating this stuff and what you can do from not a regulatory, but a reporting perspective to appear a little more green than you actually are. Got one other question in the Q&A. Again, I encourage if you have questions or comments, feel free to share them. Question here: if you continued this research track on sustainable investing, what would be the next topic or subtopic you would explore?
So I'm not sure. I think one thing we can say is we're definitely interested in kind of this idea of what you should do in terms of incentivizing firms to get more green. So like, what are the brown firms who are doing better? And so what we're trying to do is to, get a kind of a publicly available index that will look at firms that are improving, give something closer to, what we think people should be incentivizing those firms are, so that if you are that, agricultural firm that is getting more green or something like that, that there is kind of a list that people can go to and look at and look at the right metric so that you aren't just, rewarding the healthcare companies for getting slightly more green from a very green level already.
Right. So, and that mechanism, if you had that index and maybe an ETF tied to that, you could help direct assets to the types of firms that are improving. Maybe considered a classic brown firm in the old way of thinking, but they're improving. And that's really what we want to see, because ultimately those improving firms are going to have more of a positive impact on the environment.
Mhm.
Yeah, that makes sense. It also makes me wonder about, because we've touched on this, the lack of consistency in the terminology when we talk about sustainability, risk, ESG, what's green, what's brown. So can you think of any egregious examples of how people are manipulating, maybe it's wordplay, or again, we should be focusing on this, but the industry and investors tend to focus on that.
Well, so two things come to mind, which one is just the term sustainability, which I think is a wonderful marketing term because everybody thinks like has their own personal definition of what that means. And they kind of think that that's the relevant one, but definitions don't overlap particularly highly. So in an older paper, we actually ran a survey of people just say like, when you hear a firm is more sustainable, what do you think? And so environmental, everyone agrees with, like it's got something to do, but like all the other things you could think, it's like, roughly 20% of people were convinced it was there. So it's an umbrella term, it's a broad term, and I think fairly intentionally in that respect. The one thing like that's a little bit more in terms of gains that I've seen is, so you've got these kind of green products, if you will, based on ESG ratings. And around, I don't know, maybe a few years ago, the ESG ratings they were based on, I think, fundamentally changed. So initially, they were just ESG ratings, which were, how green is this firm or something like that. Now they're all ESG risk ratings. So they're meant to cover something related to future exposure of ESG risk. But if you look at like the name of the products that they're tied to, that hasn't changed. So I don't think anybody buying the products realizes that there is meant to be measuring something different. And I think it's a bit of a shell game there because I think it coincided with, concerns related to fiduciary duty by people in industry. So I think the risk ratings were very important to those building the products, and then the people buying them by and large, I think really just wanted to buy a green product. And so there, I feel like there's vague terms meaning different things to different folks on the, the chain. I think that's a bit more of a fundamental issue that has been going on.
Yeah. Okay. And there, if I heard you correctly, how we're defining risk in terms of ESG is going to change, but the fund is not going to change its holdings or its investment objective or communicate to shareholders that there has been this evolution and here's how we're evolving in terms of managing your assets.
So just for example, like Morningstar has their sustainability ratings they launched in 2016. So 2016 to I want to say about 19, maybe 2020, they were based on the Sustainalytics ESG ratings. Mm-hmm. And then, around 2020, they became based on the Sustainalytics ESG risk rating. Right. And, no one lied about this. There was a press release and it's out there. And if you read the white papers, you'll know it. But I don't think anybody to a first approximation responding to those ratings is a consumer of those ratings has any idea what's going on. And what do they think the sustainability ratings capture is not, loadings on some sort of risk, whatever that might be. Like they think they're buying green things or brown things. And that's what most people think. Even though the ratings that they're based on no longer are meant to represent that.
Yeah. I don't want to go too far down the data rabbit hole, but what data source did you use in your study and how has the data evolved? And I'll stop there. I got a follow-up question. So what'd you use and how's it evolved?
So we used mainly true cost data, which is by S&P, and that uses either directly reported firm level emissions, or it estimates its own model based upon how much the firm has produced of various types of products and its production methods and industry averages. that I think used to be kind of the best available data, although I think you can all see how it's kind of imperfect because it's either self-reported or estimated by true cost. I think the leader now is probably CDP, which is the Carbon Disclosure Project. So that's what we're using for our next tentative project, which is to rank firms by the extent to which they improve their emissions intensity. So there, it's again somewhat self-reported, but the guidelines seem to be more stringent. Although we are still using just scope 1 and scope 2 right now in terms of our reporting, and there's still various reporting inconsistencies. I'm actually curious to learn, I don't know if there's others in the audience who know of differences across countries. It's possible and likely, I think there are countries outside of the US that have more stringent reporting standards that may lead to more reliable data.
More stringent reporting standards for the companies?
For the companies, but also the funds, I think.
Okay.
Although I'm not sure I support those because they tend to focus on financed emissions or other metrics that motivate funds to basically divest away from brown firms.
Right. And that takes us back to the could divest to a private equity firm, for example, but not really addressing the issue.
Right.
One last data question, and I should know this, I think of Sustainalytics or MSCI. How many of them provide the data and how many of them provide ratings or recommendations based on the data? Like how much work does an asset owner or an investor have to do with the data, or could they just rely on MSCI saying, this is a good company, this is a bad company? Or is it a little of both?
So, I mean, all of those providers will give you some sort of combined score, which I think you could think of as advice. Like, here are Sustainalytics and MSCI will rank over a few hundred categories when you go through ES&G, and all of them will give you a top line number of here is like the ESG score for this firm, and you could just do that. Most will also give you the component parts, so you could, if you wanted to dig into it, you could kind of mess around with that data and say, I'm going to aggregate it a different way or something like that. Is that what you meant by advice, or do you mean something more? Yeah, okay.
Yeah, because hopefully one of the things that comes out of webinars such as this, again, is a more thoughtful, deeper discussion of ESG, of emissions, and asking, okay, we want to limit emissions. What does that look like? What are our data sources? What assumptions are we making? How could we be more thoughtful in our actions versus just a gut level reaction? So as long as the data is out there and people can do some of their own homework, I think that's ideal. And if I heard you correctly, yeah, you could take a Sustainalytics or an MSCI recommendation. This is a great firm, but you could also dig a little deeper into that data and say, okay, within its industry, as you suggested, this is a brown firm, but it's more green than the others. I feel better about investing in this one versus the others, something like that.
Yeah.
Go for it, Kelly.
I just wanted to add that I do think if it were free, better data is always better, but there is a cost benefit trade-off. So for the set of firms in high polluting industries, I think it is worth trying to get reliable, high quality data on emissions from them. But there's been, due to ESG investing, I think a push for highly detailed emissions reporting from all companies. This seems to be a burden on, for example, service sector companies that are releasing these 100-page climate reports in terms of their direct scope 1 emissions when it's a services company and up to a rounding error, they just don't pollute. We don't need scope 1 information from travelers, whether it's 1 ton, 2 ton, or 0 tons per million, it just doesn't matter. I mean, to some extent, we do actually care about what they're doing with their investment portfolio. Because this idea that they're just they don't have any climate risk. Actually, they're an insurance company, right? They're insuring against a lot of risk, which could include climate risk. What are they investing their financial portfolio in? So it seems like disclosure could be more targeted at the elements of a company that could actually matter for environmental or other social concerns instead of like a blanket reporting requirement for everybody.
Yep. Great point. Great point. Sam, were you going to say something?
Oh, so sorry, I was going to say, so my prior paper on the Morningstar ratings, the thing that was a bit depressing is, so Morningstar, I think, did exactly what you would want. They gave tons of details underlying the metric, but in classic Morningstar fashion, they have this 1 to 5 rating system in terms of globes. And what our paper found is all of the nuanced data that they gave was totally unimportant in terms of understanding anything. The only thing that matters is, like, did you get the 5 stamp or the 1 stamp? All of the nuance was lost, which is depressing, but you know, at least in that setting, really what mattered was not the nuance or the underlying information, but just that top line thing.
Well, a couple points on that. Going back to our earlier discussion of a simple solution to a complex problem, you know, if there's something that I can anchor on, that's what I'm going to do. And if I remember correctly from that paper, the funds and they all got re-rated at the same time. It's like on this date, boom, you all have a new ESG rating. And going forward, I think the work that you did showed the ones with the 5 globe rating attracted significantly more assets than the 1 globe. But what was the caveat to that? They weren't necessarily more green, or their performance wasn't better, or something?
So in our sample, there was not a significant, like, so if anything, the 5 globes slightly underperformed the 1 globe, but we're just looking at a year. So there wasn't anything meaningful in terms of performance. The takeaway with this, there was massive flows. So the 5 globes grew by about 6%. The 1 globe shrunk by about 6%. But, you know, it basically, all of the things that we talked about in our paper would be applicable to that. Like, those were flows to mutual funds that were just generally low emission. It would have the same counterproductive influence from you know, the other stuff we were talking about in our paper.
Yeah. And correct me if I'm wrong, I don't think we really touched on performance thus far. Can you link in performance? Because my sense of ESG in general, 2022 came around, inflation is spiking, commodity prices are surging, oil stocks are doing really well, and some people bailed on their ESG funds because they didn't hold fossil fuels. And I think Barron's had a study recently that said in 2023, $13 billion came out of ESG funds, mostly due to mediocre performance. So any thoughts on how to square returns with doing right by the environment?
I mean, I feel like this is the time series is short to have definitive answers in the data. So in many ways, I feel like, you know, just kind of thinking about what, given both theory and experience, we should expect. And I feel like every, I don't know, reasonable quant I've ever talked to who thinks they have skill has said, well, look, you know, you segment the market in any way, and you should expect lower performance, right? Because I'm a quant, I'm good at my job, you know, cut half the letters of the alphabet out at random, and my portfolio should be doing worse. So why would you necessarily expect ESG to lead to improvement? I think is a difficult one. If you think that people are willing to pay more for ESG, if they're willing to hold stocks for non-pecuniary reasons, or if you think that they value green stocks for hedging motives, those would all be reasons to expect lower performance, because you're willing to pay more today for a stock for lower performance in the future. So, I mean, if you think it's an outperformance story, it kind of has to be a market mispricing story, that, you know, green stocks are systematically mispriced. Because of that, you will end up with better performance. And I'd say I'm somewhat sympathetic to historical versions of that, like maybe in the 1980s, no one was thinking about this, and we should have been thinking about this as something, and it was not priced. But given it's, I'd say, arguably been the most attention grabbing thing in the market over the last 5-10 years, I think those mispricing stories have gotten trickier. So, you can look at the data, and I think the answer is noisy. I think some people find underperformance, some find overperformance. And then also, of course, because there's been this big growth, you would expect if it was, say, efficiently priced and then ESG rating, ESG investing comes on and people are willing to pay more, you'd expect a short-term run-up before a period of kind of long-term underperformance. And so, I mean, all of these things are kind of happening at the same time. But so empirically, it's hard to answer, but I'd say most finance logic points to either, small but not, substantial portfolio drag or underperformance, with arguments about substantial overperformance, I think are difficult.
Yeah, I'm with you. Very well stated in terms of we're looking at a pretty short performance history, but my recollection is maybe 5, 6, 7 years ago, there was a strain of logic out there that said I can get better returns, lower risk as defined by standard deviation, drawdown, whatever. I'm going to do a great job for the environment, and I'm going to have all of the best of all possible worlds. And that came to a bit of a halt in 2022. So we'll see how it plays out going forward. We have about 8 minutes left. We have another question. Thank you, Walter, that just came in. You've discussed MSCI and Sustainalytics ratings quite a bit, but it was long since discontinued KLD data that you used in your study, right?
No, we did not use KLD data.
Okay.
We used true cost emissions data. And we showed, I think that, so that because we focused on emissions, and then we used MSCI environmental ratings to show that those ratings mapped onto percentage reductions in emissions rather than level reductions in emissions. But largely, we've just focused on emissions data.
Okay, and just to be sure, because I know the players get bought, it was A4, it was Refinitiv, it was so-and-so. So the data that you used wasn't purchased by, the KLD data wasn't purchased by somebody else.
I think MSCI did purchase KLD, and that the MSCI ratings now, like I think that's right, isn't that? I think that MSCI ratings are what were KLD ratings.
Okay, yeah, and I think that's what Walter's saying in the chat.
Okay.
The data relating to ESG ratings come from MSCI ESG ratings. The data was previously known.
Okay. But mainly our paper is not about the ratings, it's about changes in emissions, which is from true cost. So that's outside of the MSCI system.
Okay. We've got just a few minutes left. I've been asking a ton of questions. We've got a few come in via Q&A. Sam or Kelly, anything that you want to hit on that I haven't asked about or somebody else hasn't asked about?
I did want to just add one thing, which is, so I just want to kind of like reiterate and really pile on to Sam's complaints about ESG risk ratings. So, I think it's entirely reasonable as any investor to care about the risk of your portfolio holdings. And if something is riskier, all else equal, to demand a higher return or otherwise be less willing to hold it. Okay. So it's not, unreasonable to consider risk, but it's not at all clear to me how measures of how well a firm is doing environmentally, social, or in terms of governance relate to its actual financial risk. I think you can tell a story in which being higher ESG might insulate you from possible regulatory risk, or because you have a loyal consumer base that thinks you're green, maybe you're less risky. But it's really not clear how material these risks actually are. And it seems like there's this push for, because of this anti-ESG backlash and potential litigation risk, A lot of fund managers are under pressure both to invest with ESG in mind, but also not say that they're distorting their portfolio other than to maximize their risk and return profile. So the way around this seems to be to stuff all of ESG under this kind of concern for risk measure. Okay. And that seems very deceptive, actually. For us to say we're going to divest away from brown firms only because we want to minimize or maximize the risk over, so the return over risk profile of your portfolio.
Yeah. So again, what is that risk? How do you quantify it? And what's the connection between ESG and, if I heard you correctly, again, more of your standard performance risk measures? Because right now, ESG risk, environmental risk, and investment risk, financing risk all get kind of bundled into one group.
Yeah, and I mean, it's not clear to me what governance risk is either. Or just how governance fits in any of this. It's some of the previous outperformance of various ESG funds can be loaded up on the G component of ESG, which is not something that necessarily investors care that much about, but it seems like well-governed firms, so firms that didn't have anti-takeover protections, were better managed, had more independent board members. Those firms were undervalued and subsequently outperformed investor expectations. So having G within the ESG allowed some of these ESG funds to have a good record in terms of return performance. But really, this G is now being underweighted in terms of importance. And it's also not clear that investors care about, when you think of the typical green investor, it's not someone that is very concerned about, I want this firm not to have an anti-takeover poison pill. Okay. But that's really what goes on in the G metric.
Yeah. And I might argue that governance is maybe the most important of the ESG trifecta. If a firm is well governed, it could address environmental and social issues. But maybe to your point, how do you best measure that? The independent directors is flawed. Even going back to Sarbanes-Oxley. We could have a conversation about that for another hour and a half. Sam, you look like you got something to share.
Oh, so I'm sorry. I was just thinking of a related point to Kelly's, which is like I always think of the thought experiment with the risk ratings comment of like, well, let's say that one of these ratings was doing unbiased research and found that like in their models, oil firms were a great hedge for global warming for whatever reason. Like the political PR disaster that would occur if they were to say, well, look, we've run our risk models. And as we said, we have no idea what the risk, but everyone should hold Exxon and BP if they want to hedge climate risk. Like people would throw up their arms, even if that was the honest, right way to do the risks. And I've always found that kind of, at least to me, quite convincing that no one really wants these to be risk ratings, even though they're called risk ratings. Because I mean, maybe oil firms aren't the right example, but there's got to be some firms that are high polluting that you would expect to be, maybe a hedge against global warming, and some that are low polluting that aren't. And that's just not how these things tend to work.
Yeah. Well, again, I'm as guilty as the next guy of hearing what I want to hear, but winding up our discussion, the importance of looking at these metrics, whatever they are, on a company-specific basis, I think is vital. And not taking the easy course of action or the course of action that spares you scrutiny from clients or stakeholders is important to your investment returns and to what we're doing for the environment. So, again, I've mentioned this before, be open-minded, be more thoughtful about ESG, its role in your investment philosophy and how you're executing it, and be open to the type of work that you've done and others. I mean, I'm trying to put a bow on this, but I don't know, any closing thoughts on that?
I thought that was a great closing thought.
Okay, well, thank you. We're at top of the hour here, so again, we're gonna wind things down. And before we close the discussion, just again, want to thank everybody who's joined us, and of course, thank you to Sam and Kelly. I will say, if you're interested in getting on the Brandis Center's email list to be notified of future events, I just put my email in the chat, so feel free to hit me up. We promise we won't inundate you with emails, but we're starting to do these types of webinars a little more consistently. And one other thing I just want to mention, we talked about this at the start. You all won our Call for Papers contest last year. We're going to promote another contest this year, probably set the deadline for first quarter in 25, but there'll be another $25,000 prize, which will be split among professors and graduate students. And that's made possible by a generous donation from Brandis Investment Partners. So if you're interested in entering, look for more information about that in the future. So to wind it up, just again, thank you everybody for joining us. Kelly, thank you. Sam, thank you. This will conclude our event for today.